Thank you so much. Just give you a quick, thanks. Quick background about us. We're the Georgetown Real Estate Alumni Association. We're not officially affiliated with Georgetown, which allows us to pretty much include everyone and not just students, alumni, and faculty. So again, if you have some time, please go on our website, see what we can offer. Our benefits are we coordinate networking events like this. We do property tours, and we just try to like get the community of the real estate community involved, network with each other, and try to like bring informative and interesting discussion to the table, as we can see here today. Then a little bit of a background about Ali. Ali Semir is graduated in 2011 from Georgetown Real Estate Program. He's the principal and founder of Mosaic Affordable Housing. He has a background in acquisition, development, operations of affordable multifamily apartment buildings in the DC, Virginia, and Georgia area. He delivered over 4 million in partnership distributions across 330 multifamily units located in 12 properties. And he has a bachelor in business with concentration in real estate from VCU. He's also on the board of trustees for Meridian Public Charter Schools and the board of directors for the Family Lifeline. So not just a pure businessman, but also a person of the community that gives. And we're super excited to keep this panel series going with Ali. I think it's been a pleasure working with him and to see really great panelists that he is able to bring together to have a very interesting and thoughtful discussion here today. With that being said, I'd like to give it over to Ali.
Thank you so much. Wonderful. Thank you, Mark. Thank you, Georgetown, and thank you to our attendees. Can you all hear me? Yes. Good. Oh, yeah. Have all of this? On Zoom. Thank you. Thank you, Mark. Thank you, Georgetown, and thank you to our attendees. In addition to owning and operating properties and securing the best debt for our deals, we also have placed over 100 million of the best commercial real estate debt for our valued clients, with a focus on affordable housing. As Mark mentioned, at last count, we had over 150 registered people for this event. So given the focus, when I started this event alongside Mark and Glenn, we were targeting somewhere between 25 and 50 people. So I think it's safe to say there's demand here. Some people have referred to it as catching lightning in a bottle. So really appreciate you all for taking time out of today and being here with us. We look forward to a very lively conversation tonight. It's great to see the level of interest in our event. We appreciate your attendance here, both for the folks in person and on Zoom. And again, I look forward to a lively discussion of a very timely and sensitive topic. Today, we aim to dissect affordable housing, define what it is and why it is important. With housing expense being the largest contributor of the Consumer Price Index, or CPI, housing is of significant focus to the Federal Reserve, to lawmakers, and really to all of us. We will focus today's conversation on the types of affordable rental housing to distinguish from housing affordability on the ownership side, which I will introduce to you shortly. Housekeeping items in the spirit of promoting dialogue. Folks in person, please raise your hand for follow-up questions that are on topic. We will also have a Q&A session where you're welcome to ask whatever you like at the end of the session. We will try our best to get to everyone's question. For folks on Zoom, please type in your questions and we'll do our best to try to get to everyone. Now, I will introduce our esteemed panelists. Equity, inclusion, and belonging is a passion for Ernst Valerie. The AQUO Fund, did I pronounce that correctly? Thank you. The AQUO Fund at AQUOfund.com is a platform created and led by Ernst to level the playing field and give access to the most vulnerable and excluded by traditional capital institutions and the processes they created to marginalize minorities of color, women, and immigrants from impacted countries. Equal Fund underwrites mission, capacity, and integrity. Equal will work tirelessly to provide access that will lead to diversity and development, resulting in healthier communities. Mr. Ernst Valerie is a co-managing member of SAA EVI and shares overall responsibility for the day-to-day operations and execution of SAA EVI projects and relationships. Mr. Valerie has successfully invested in and developed real estate in Maryland, Washington, D.C., Pennsylvania, Virginia, California, and New York. For the past 22 years, he has been involved with development projects ranging from mixed-use, multi-tenant rental properties, single-family renovations, and condominium conversions. Mr. Valerie is the founder and president of SAA EVI affiliate Ernst Valerie Investments Corporation, EVI. As a private minority-owned real estate investment firm established in 2001, EVI invests in select underserved and undervalued key emerging domestic real estate markets defined as urban transitional areas with high residential and retail demand. Mr. Valerie has extensive experience in affordable housing and market rate housing developments, and it has invested in investments including providing due diligence capabilities and extensive skills in budget planning, design development, marketing, and the supervision and guidance of contractors, architects, and engineers. He's responsible for the securing and structuring of financing, including expertise in securing historic and new markets tax credits. As a quick aside, if anyone knows how challenging obtaining new markets tax credits are, you know that tall of a feat that is. Mr. Valerie is also active in social entrepreneurship and volunteer work, including a collaboration with a team of professionals and graduates from the MIT CoLab, as well as efforts at the incubating businesses around the world that help alleviate poverty and increase the earning potential of low-income individuals, families, and communities. Mr. Valerie graduated from Columbia University's Master of Science program in Real Estate Development. He also obtained a master's degree in policy analysis and public administration and a bachelor degree and a Bachelor of Science degree in urban and regional planning with a concentration in international relations, both from Cornell University. Ernst is also a Mel King Community Fellow at MIT's CoLab and an adjunct professor at the University of Chicago Booth School of Business. Join me in welcoming Ernst Valerie. I'm also joined with Ben Miller. Ben is a principal and founder of Wellington Development Partners, with primary responsibility for asset and land acquisition, financing, and development. Throughout his 20-plus year career, Ben has been involved in financing, acquisition, development, rehabilitation, management, and disposition of approximately $2 billion in commercial real estate assets nationwide. Ben was previously a senior vice president at CW Capital, where he directed the operation, rehabilitation, and repositioning of a $1.1 billion real estate portfolio, including 136 multifamily properties, totaling 17,800 units, and 2.2 million square feet of commercial and retail space across the United States. His financing experience also includes the use of conventional debt and equity, NMTCs, LIHTC, tax-exempt bonds, and historic tax credits. Ben is currently vice chairman of Loudoun County's Affordable Dwelling Unit Advisory Board, ADUAB. He holds a BA in history from Denison University and an MBA from the University of Virginia's Darden Graduate School of Business Administration. Ben lives in Loudoun County with his wife, Alyssa, and 3 children. Ben, welcome. Please join me in welcoming Ben. I'm also joined with Scott Hutter, who is the Director of Multifamily Lending and Neighborhood Investments from DC HFA. Scott Hutter leads a team of underwriters at the DC Housing Finance Agency. His team finances pre-development loans, tax-exempt bond issuances, and HUD risk share loans for affordable housing properties. Prior to working at the DC HFA, Scott worked at Novogradac and Company, managing a team of analysts that completed appraisals and market studies for affordable housing. Scott has over 9 years of experience in affordable housing and is a graduate of the Georgetown Masters in Real Estate program. Welcome, Scott. Charles is the Director of Real Estate Development for APA, or otherwise known as the Arlington Partnership for Affordable Housing. Charles Sims joined APA in April 2019 as a project manager and was promoted to Director of Real Estate Development in January 22. Charles is responsible for overseeing half of APA's development, including current and pipeline projects. Charles supports several project managers, evaluates properties for future development opportunities, and co-leads the real estate development team. Charles contributes to APA's regional expansion by supporting projects throughout Maryland and Virginia. Charles has led and supported several notable APA development projects, including Marabella Campus redevelopment, which is the development of a 134-unit garden-style affordable housing community into 621 units of affordable housing across 3 development projects involving both preservation and new construction. Previously, Charles worked as a senior construction project manager for Office Depot Office Max in Boca Raton, Florida, and new urban development in Miami, Florida. Charles managed multifamily new construction and redevelopment projects, industrial and retail development projects, working in both high-density urban and suburban environments throughout the southeastern U.S. Please join me in welcoming Charles Sims. And we also are fortunate enough to have Myron Adote. Am I pronouncing that name? Adote, pardon. Is an investor and financial professional with more than a decade of experience in real estate investments and financing. Myron founded AYA Enterprises LLC, which is a capital markets firm sourcing the full capital stack for middle market real estate developers in 2020. Throughout Myron's career, he's completed over $100 million of commercial transactions with another $100 million in the pipeline. He is a venture at Rebel One Ventures, an early stage venture capital syndication firm. In the greater New York area, Myron worked for Reese, which is now Moody's Analytics Reese, where he consulted in different capacities, including commercial real estate data, modeled economic data for commercial real estate, and closed one of the company's top 10 new business deals, which is Brixmor, in the retail sector for 2014. Myron is certified in Reese 2.0 subscriber addition data analysis and acquired his life, accidental, and health and Series 7 and 66 licenses. He is a guest venture capital judge and business mentor for the Georgetown University Law School Entrepreneurship Practicum and a member of the Diversity and Commercial Real Estate Conference Host Committee, which runs the largest diverse commercial real estate conference in the country. Myron has spoken as the United Nations, the U.S. Black Chamber Conference, the U.S. Black Chamber, the National Urban League, and BizNow's Multifamily Annual Conference. He has also been featured on NPR's Streetwise program, which is a real estate show that explores industry trends and issues. Myron's interest in community service led to his appointment as the CFO treasurer for New Passage Foundation, a nonprofit organization dedicated to connecting with and expanding the African diaspora. He received the Presidential Silver Volunteer Service Award in 2022. Myron completed his Bachelor of Science in Marketing and Communication, along with an MBA in Management and Entrepreneurship at Fordham University. He lives with his wife, Courtney, in New Jersey and Virginia. Please join me in welcoming Myron. I did say esteemed panel, right? That was a mouthful. I'm going to start with a couple of quick slides. So let's first start off. Affordable housing is a very broad topic. So we want to focus on affordable housing, particularly affordable rental housing. And I'm also going to talk about the distinctions across AMIs, or area median incomes. I want to highlight some of the notable variances across income spectrums with population in comparison to total demand. So population and total units. There are 44.1 million renter households in the country and 46 million rental units with complete kitchen and plumbing. Of these 44.1 million households, 11 million have extremely low incomes, defined as 30% of AMI or below. Only 3.7 million, that's here on the upper right. Of those 11 million people, there's only 3.7 million rental units. So at this income level, renters face a shortage of 7.3 million rental units. At the 50% of AMI mark, which is the next sticker down from there, we add to the disparity. So an additional 6.8 million rental households have low income up to the 50% of AMI threshold. And an additional 6.1 million units are affordable to renters below that 50% of AMI mark. So the disparity only grows once we incorporate folks in the 50% of AMI spectrum. And that trend reverses as soon as we hit the 80% of AMI. So 80 to 120% of AMI is generally considered as market rate. Obviously, when we look at things from a national perspective, and when we focus in on DC, DC has a very high AMI. So even something that supports 100% of AMI in DC is technically considered middle market or affordable, despite it being not really affordable, right? So even though there are about an equilibrium of rental units and population, once we dive deeper and we look into the actual spectrum of units to AMI levels, that's where we get this big disparity. That same disparity is not in the all income levels, and it's certainly not in the 100% of AMI levels. So now we're going to get into the question and answer with my esteemed panel. So I think we've defined what incomes are. We've defined the focus of today's conversation in affordable housing rental. And I'd love to hear from my panelists. Let's start with Myron. With understanding the crisis, Myron, in your view, what are the primary factors contributing to the current affordable housing crisis in urban areas like Washington, D.C.?
Ali, thanks for putting this together, and let's dive into it. I think the biggest thing that has been a contributor to the crisis of affordability has been essentially gentrification, which is with an emphasis on the luxury housing, market rate housing over the past decade, combined with a record low cost of capital over that same time frame. For developers, and not all developers, but for a large chunk of them, the upside has been greater in their view in creating that sort of housing. And if you're able to get that kind of housing with a low cost of capital, that has incentivized them to do so. And in doing that and incentivizing this sort of luxury housing over this extended period of time, you end up with the sorts of disparities that you were displaying on the slide just beforehand, which is essentially a large demand for affordable housing and a huge shortfall in supply. So that's what I think has really caused this.
Thanks for that. I'm going to pass this mic over to Scott. Scott and I are going to share a mic for his answer. I'd love to just get your answer on that. What are the primary factors contributing to the current affordable housing crisis, specifically in DC?
Sure. So in Washington, D.C., what we've been finding is there's just a limited amount of land in which you can build an apartment community on. There's not that many sites that are zoned for that. And as time goes on, people are developing on harder and harder sites to construct. They're more likely to have environmental contamination. They're more likely to be smaller sites, be triangular sites. So they're harder to build on, and they're smaller. So that's one thing that we see. Additionally, in terms of looking at the time in which it takes to build a project, entitlements do take a long time in terms of pre-development. You have to go through the entitlement process is extensive. There are many authorities that you do have to go through to receive your permits, and so that takes longer. There's more costs associated with going through paying the specialist to get through that process and receive those entitlements. And as you go through, the costs of your pre-development capital add up, and the longer it takes for you to get up out of the ground, the more you have to pay in interest. So we see that, and then the last thing that I see is there's just a really limited supply of folks that are still in the construction trades. I think when you look at what happened in 2007 and 2008, a lot of people viewed construction as a great opportunity, and then the market stopped, and not many people decided to move into the construction trades. So there's fewer construction workers, fewer tradesmen, and that drives up construction costs and it drives up labor costs. So I think that's the way that I see it in terms of a cost factor, and really the more expensive it is to build housing, the higher the rents need to be able to justify the construction of that housing without any sort of governmental subsidies.
Thanks for that. I also want to get Charles to provide some way in on that.
So, one, thank you so much for putting this together, and I'm really excited to be here with everybody. So I think I'd like to take a different look at it, right? Kind of holistically. So really what we're doing in affordable housing is battling wealth and income inequality. And that is a trend that's been going on for quite a while, and I'll touch on that in just a sec. So when you're pushing against a tidal wave of wealth and income inequality, it's almost as if you're always a little short. And so what's been happening with that? So if you take a look from 1979 to present, we've had a 61.8% in productivity, 17.5% income growth. So when you look at that, it's almost obvious that we're going to have this affordability issue. And I'll add something else I looked up in my research for this question, which is housing production pre-1974, when it was public housing before Nixon put a moratorium on it. We produced, the numbers are foggy here, so I got anywhere from 1.4 to 4 million public housing units, and that's in the 37-year history of the public housing program before the moratorium. The LIHTC program has been around for 37 years as of last year, and it's produced about 2.6 million. The other difference is in 1974, we had a population of 203 million. We got 335 million today. So why do we have this gap, right? Why is this here? It kind of is almost obvious that we need additional contributions. We need a bigger commitment from government to allocate to housing because of the issue that we have, all the other issues that come from that. So just wanted to frame that question and kind of frame the affordability landscape globally, and that has implications in DC directly.
Thanks for that. You brought up some incredible points. And I think what might help is to separate out what we're talking about, right? So we said rental housing, we said affordable, and to further define that, there's the LIHTC side, which stands for low income housing tax credits, and that could be at various income spectrums. But in addition to that, there's also naturally occurring, or what's called NOAA, naturally occurring affordable housing. And so, Charles, would it be safe to say that you all focus on LIHTC and or mixed income?
Oh, that's correct. APA focuses on LIHTC development primarily.
Okay.
We do have some product that is nowhere naturally occurring affordable, but primarily that's the primary tool we use to create affordable housing.
Got it. Thanks for that. And so there's also this like diversity of thought across panelists as well, because APA by nature is a nonprofit LIHTC developer. Ben, I know you've done your setup as a for-profit, but also in LIHTC development. So would love to get your take on that as well. What are the primary factors contributing to the current affordable housing crisis in DC?
Yeah, I think, and Charles and Myron sort of hit on that, right? That you had the economic incentives or disincentives, right? And then you had a lack of really political will, and that's not necessarily the case for DC, because DC has always been a renter population and has had a huge commitment to affordable housing. But really, the outer suburbs have lacked the political will to incentivize and to require affordable housing. And Arlington was the first and then Fairfax, but now we're seeing Prince William is now. I mean, I'm getting calls from folks in King George, right? And we're seeing there was an article in one of the local papers about people moving out of Hampton Roads in Northern Virginia into more rural areas. So we're going to start to see that spread of need for affordable housing. But I think a lot of it really was just recently where local politicians have now requiring and mandating more affordable housing. And so a lot of our projects that we do are with larger master plan communities of 300, 200 acres with big national builders who have now a huge affordable requirement and don't have the capability to do it. And so we partner with them to handle the affordable. But I think that was a big driver, is that it just wasn't required, that it wasn't pushed, and now it is. And so we're fortunate that folks are starting to sort of to get wise. I always joke, I probably 15 years ago, I'd go to a conference and I'd be the redheaded stepchild. Right now, I'm the belle of the ball. Everyone wants to talk about affordable housing, and so it's kind of nice to see. We did a project with APA and Charles, a 100-unit senior 62 plus, and I think that we leased that up in probably 3 months, if that. It's always full. I mean, the demand is just there, and I think, I talked about the politicians, and I always, it's sort of the affordable housing certainly is a Democrat led. I mean, most of the initiatives at local and national level, for the most part. The interesting is that, the local chambers, and I imagine this is the case up in the tri-state area, the Republicans are hearing from the business people, we can't hire people, right? In Loudoun County, I have a buddy at a dance studio. He offered a job to somebody from LA. Now, LA, she said she couldn't afford to live in Loudoun County. And that's how bad it's gotten. And so all of a sudden now, even the R's are like, we gotta be able to house people, or our business are going to suffer because they can't hire anybody. And so fortunately, I think we're starting to see, Charles used the term wave. I think maybe that wave is going in the right direction.
It used to be where affordable housing was almost a bad word. I don't want to touch it. It's everything else. We want these shiny glass buildings. Drawing from personal experience at Freddie Mac during conservatorship, but the early days, that's what we wanted. We wanted the shiny glass buildings, and that's what we bid aggressively on against Fannie Mae and some other competitors. I think that shift has changed in that target, a lot largely driven by FHFA, right? And setting the focus for affordable housing, but very good points, very good points. I think Ernst has unique perspective on this because he plays in many geographical sandboxes. And so you have the benefit, Ernst, of knowing how affordability, either crisis or cities that are doing well in certain cases. I'd love to get your take on that, Ernst. What do you think DC is doing well, DC MSA is doing well in comparison to some of the other areas where you have properties?
So if I compare these DC to like the Bay Area, right? We mentioned limited amount of land and zoning, right? And so zoning is one of those ways of saying one thing and then doing another, right? So the Bay Area, when you think of San Francisco and Oakland, you think, my God, they're so welcoming, they're so liberal, they're such great people, right? But they've used zoning to actually, create this housing crisis. And then they're like, oh, what happened? San Francisco, 85% of that city is zoned single family. And then they're telling you that, it's raining when they're actually, urinating on you, right? And so DC, I can say for a fact, does not do that, right? DC tries to be creative, and they've always put extra dollars. So if you by some miracle can get the land, they'll work with you on zoning. They'll give you sort of like bonus, zoning, and then there's dollars involved. Beyond DCHFA being like an organization that actually works, right? You don't even have to go private placement. Typically, people will pay more to do a private placement as opposed to go through sort of like a semi-government entity because, you know, it's worth it. They actually get the deal done. But here in DC, you have functioning DCHFA functions, DHCD functions, and there's always additional dollars, right? So DC has this housing production trust fund, right? So as all these shiny new buildings get built, money goes back in the pot to create affordable housing and to make sure that everyone is still here when it's all said and done. So there's a certain level of gentrification that's happening, but there's this recognition that we need to keep DC diverse. And I don't see that in other places that have a more kind of inclusive narrative, but it's this false narrative. And I always look at California, and especially Northern California and that Bay Area, their narrative is different than the reality. Right. And so the next point is the entitlement process. Right. So the entitlement process here in DC, while it's difficult, you can get through it. You can hire, you know, and when you hire, it's more expensive, but you'll be able to get through it. And then there is a process of getting pre-development dollars. There is sort of like a network of nonprofit organizations that will help you get to that finish line. Other places, the entitlement process is very difficult and they don't want you to get through it. In fact, it's a source of corruption for them. It's a source of use my people or you don't get through, right? And so DC's lucky not to have something like that. And the third thing, you know, the 3 points that were mentioned, like limited supply of folks who build, right? That's a big one. And one of the things I'll go beyond that. It's not just who builds and it's who gets to develop, right? So the stat that I have, we have a lot of these cities, the top 25 cities in America, right? They are, for the most part, majority women. Like if it's an urban area, they're majority women. And a lot of these cities like DC, they're predominantly Black, Latino, right? Minority. And so guess how many of those people get to be developers out of 100 and, you know, I guess like 12,000 plus developers of medium and large size development companies, less than 110 of that are minorities and women kind of combined, right? So in a place like Baltimore, in a place like DC, less than 2% of the capital that goes into development goes to women and minorities combined, right? And it's not, so like if you're white and you're thinking, well, great for me, you get screwed too, because that money is actually not going to you. It's going to this small handful of people that somehow have been deemed the ones that get to develop, right? So like, so when development doesn't come from the community, when the community doesn't have access to development, that's why you go into, there are zip codes right now in DC. As much as everything is taking off in DC, there's cranes everywhere. There are zip codes in DC right now that nothing's happened. And it's because they're waiting for those people, right, to lose their opportunities. And we also know that there's bias in appraisals. So like if it's a person of color that owns that property and is trying to sell it, it has no value. The only value that gets assigned to it, there's no appraiser coming and assigning value and, you know, realtors saying this has value. It's the, you know, posting on the lamppost that says we buy cash, and it's someone trying to take advantage of. And that's why it's worth nothing, right? Because we own it. And this isn't like a figment of our imagination. I have a business partner that likes to say, you like conspiracy theories. And so that's why I started doing work at MIT and all these places where I deal with data, because it's not conspiracy, it's actually happening. And so the third thing is I think we need to really address, you know, the diversity and who gets to develop. And I think once we've addressed that, we have more developers of color, we have more women who develop, and we have more immigrants who develop. And I always say a special type of immigrant, because it's really the immigrants from shithole countries that never get an opportunity. Right. And I think I say it better. But like if you're from, you know, a certain place, you're never going to get the opportunity. And you're the one working 2, 3 jobs and like not getting that opportunity. And so those are the things that are going to help make these cities better. And I think people kind of, and we know that. And when we've allowed those things to happen, communities thrive, right? You go into like LA, right? When sort of like Koreatown and LA, when those folks, they basically leapfrog the whole system. They're like, you're not going to give us money. You're not. So they created their own type of thing. Women from the Caribbean, they create these things called susus, and like they share they sort of like leapfrog the banking system. And ultimately, I think we're going to have to like leapfrog the banking system, but our government is so controlled by the traditional banking system, right? It's controlled by Wall Street. And so, at some point we have to get capital. And so that's what the AQUO fund is sort of all about. How do we get capital to all people? And it's all people who have been marginalized. So if you're from like the hillside of West Virginia and no one's ever thought of giving you any capital to do anything, this is the type of fund that's going to sort of like disrupt the normal way of doing things. And I think that's how all the movements that we had during COVID, that really means nothing. Like the NFL has stopped taking a knee. Like they just want you to focus on Taylor Swift now, right? But at the end of the day, we have to go back. Like, why did we have the Me Too movement? Why did we have the Black Lives Matters movement? Why did we really focus on like the violence against Asian Americans, and really start to like transfer capital and give access to capital to more people, and then our communities will be okay, right? And then the only way to get out of these things is through more production. I'm no top economist, but if we have a supply problem, right? We have a supply problem. How do we supply more? How do we get more capital involved in this? And then how do we democratize who gets to do it? And it's something that we just haven't been sort of like committed to doing. And so we say all these other things, but it's all window dressing to what's really happening.
It was a lot, but absolutely right. There's a lot to cover there. And first of all, I appreciate you saying all of those things. I want to focus specifically on the AQUO fund for a second. You hit on a lot of points that really resonated with me. Can you tell me more about the AQUO fund? What's the target? How do you get capital to folks that have been overlooked? How does that happen?
I'll be quick. So we started the fund with like $5 million, $1 million of equity, 4 million of debt. And we said, there's all these really talented people that haven't gotten equity. And so we started with like a single family rehab or new construction. And we provided all the capital. And at the end of the day, it was a 50-50 proposition. It was like, you didn't have to go to a hard money lender. You didn't have to get underwritten, because a lot of people, so in certain communities, a 548, a 648 credit score, that's like gold, right? And the people getting 700, it's like a hipster whose parents still pay for their credit cards. That's how they get like a 700 credit score. In other communities, that's not the case. And so the whole point was, if you're talented, let's go back to meritocracy, and you could do this and you've proven to be able to do it. We want to give you equity to do that. So that's AQUO 1. AQUO 2 is what we've noticed in the light tech business, and it happened to me. I had folks that were happy to take my money as pre-development dollars. They were happy to have me put those applications together that would fit on a table from here to here, but they didn't want me to be a GP. They didn't want me to get what's your 25-30. So if you've never done a tax credit deal, you can't do one with HUD. HUD will not allow their HAP contract to be transferred to you if you don't have a track record with them. So if someone doesn't walk you in, how do you ever get in? So we took the back door, back window in. One of my classmates from grad school, his father had done the first tax credit deal. I think it's really the second, but he likes saying the first. But he had done the second tax credit deal in the city of Buffalo. And when we went to grad school together, we basically took over his company. He had retired. We had to go all the way to Florida on his it was Bonita Springs. It was like a golf community that he lived in. We went in and we said, hey, Stuart, like, we'll take over the company. And that was how we were able to go to HUD and say, it's just new leadership. And what HUD said to me, and I remember the day I was standing in HUD offices in Baltimore and they said, you got us. And I'm like, wait a minute. I spent all my life thinking you got to go to these Ivy League schools, you got to do all these things. And at the end, I have to trick the system to allow me to do something that is giving back to the community. Right. So you've got to trick the system. And some people don't have to trick the system because they grow up in a developer family. If folks know, Trump has been able to develop because his father was an affordable housing developer in Queens. He got in. Trump could do a tax credit deal and I couldn't. Right. And so what we're doing with Equal Fund 2 is we're going to make an enterprise level investment in a person that knows how to do tax credit deals. And we're going to walk them in the front door at HUD and say, this joint venture. And the other thing that we're able to provide to folks is they tell you you can do a deal and they come up with these programs and they come up with these pre-development dollars. It's all a tease because at the end of the day, when your tax credit investor looks at you, when your bank looks at you, liquidity, where is your balance sheet, all things that you may not have. And so they're going to be things that the Equal Fund is going to be able to walk you through and get you to do your first deal. So instead of making a high salary, you can make a large developer fee. My first deal, I put up the pre-development dollars and it was here in DC. I put up the pre-development dollars. I did all like the work with the team and I learned the whole thing and I got a return on my dollars. And then I saw that they got an $8 million developer fee. I'm like, well, how do you do that? And they did not want to let me in that door, right? And so I think it's my mission, like a lot of people who have been in these positions before, they shut the door behind them and they want to be the exceptional woman. They want to be the exceptional Black person, the exceptional kind of Latino person, and no one else ever comes through. And so we've got to make it where just really smart people. And what I really want to get to is just meritocracy. It doesn't matter your race, your color, your height. If you're really smart and you have a passion for community, you should be able to do that. And we're just not ready for that, right? And so we say it's, oh, look, it's what's happening to me because I'm this color or this, and that's not right. Like, we're all in the same boat. There's like this really small minority of really rich people that like it this way. They don't want to have parity in housing. They don't want to have it where, because they're making a ton of money right now with us not being able to afford to live in these communities that we grow up in and that we've given everything to.
As conspiracy theory as your partner said about you, the idea of meritocracy is absolutely right. The other thing is, how do you do your first LIHTC deal? Well, you have to do a LIHTC deal in the past. So how do you get to the table? The IRS forms and the GP, if you're not a GP, if you're an LP investor in a LIHTC deal, you're still not doing it. So the fact that they'll provide GP access, and look, let's face it, right? When you read the Virginia QAP, the qualified allocation plan, there's questions in there about previous history with LIHTC specifically in Virginia. So unless you've done deals, how do you do it? There's a number of pitfalls to get on. I want to follow that same conversation point for a second and ask the panelists, for anyone that want to jump on the grenade that I'm about to drop. The Equal Fund is fantastic. I love everything that I'm hearing about it. How are you all addressing, do you partner with individuals to allow them to get their first deal and provide GP access? How are you all helping to increase the supply of affordable housing by increasing the people that want to do it? How does that happen?
Sure. So just as a background, again, I'm with the DC Housing Finance Agency, so I'll have a different take on it than the other gentlemen that are here. I think that there's two avenues that we help folks out when they're emerging developers. They're trying to do their first transaction or trying to go from having done a few small transactions and really scaling their business. So the first is we have pre-development funds that we use to assist developers at a below market rate. We structure these loans as bullet loans, so it's something where the interest rate is payable when you actually go to the closing for your construction loan. So that's beneficial. We've been using a general market rate loan, not market rate, but it's generally for everyone. And right now we're working to develop our own DEI pre-development loan that's really trying to solve for a lot of the concerns that Ernest is talking about in terms of issues with folks not necessarily having the balance sheet or the liquidity, but having the know-how from working as a developer for a firm or having done some smaller transactions. So that's one avenue. We provide the pre-development dollars. The other thing that we do is we have a housing investment platform in which we provide below market equity for emerging developers. And so a lot of folks, they're coming up, they're trying to build small home ownership projects, say a stick of townhomes with 4 units. And they realize that there's not really capital out there for them to go out there and get equity. And so instead, they look at doing the transaction with hard money loan. And with that hard money loan, the deal terms are so onerous, the interest rate is so onerous that you're stuck flipping houses, and you flip houses or you do small projects and you never have the opportunity to scale. And so with DCHFA, we have a lending source called the Housing Investment Platform where we provide this below market equity. The developer will come in with 20% of the equity and will cover the remaining 80% at a preferred rate of return. So that's been very beneficial for folks. It's enabled developers to scale. We've worked with H2 and Harvey Yancey. He's been very successful. Tom Kadita, a lot of hometown heroes here in DC. So love working with the community, and we try and find these gaps, just like Ernest was talking about, to fill them and see how we can finance where other folks are not going.
Wonderful. Anyone else want to take that question? Let me rephrase that question to either or both Charles and Ben. Have you all partnered with emerging developers, or just, it sounds like you all have partnered with each other. Tell me more about some of the partnerships that you look at.
Yeah, I mean, we typically will always have a nonprofit partner because our housing has a huge service component. We tend to do housing that serves the 60, 50, and 30 of AMI and provide a lot of resident services. And the nonprofits like APA do that very well as real estate development. But to Ernst's point, we in terms of bringing people along and how hard it is to be part of the GP, we have our head of development, who is, I don't know, 30 years old and very smart African-American. And we cut him in and we made him 25% of the GP. So that when he gets his 8609s, he can then go. Now I joke, I'm like, I don't want you to get your 8609s and then leave me go out on your own, right? But I mean, that's the only way you can do it. Ironically, Virginia Housing, it used to be that you were on a list, experienced, and they had individuals and nonprofits. And now they've changed that, and it really kind of incentivizes more recent deals. So ironically, we although we've done, and our partners have done 10,000 plus units in Virginia Housing guys, we are not an experienced developer because we don't have our 8609s, or we have a few from very recently and then a ton from back. There's a gap and they have anyway. And so it's just, the point being is, even if you've been doing it, it's hard. And if you're trying to break into it, it's that much harder. And so I think we owe it to everybody to try to help bring people along and not only just show them the ropes, but figure out how they can get qualified and allow them to be able to do more. That's the only way that you're going to build more of this. If there are more people building it, right? I mean, yeah. That's exactly right. Charles, would you like to take that question?
Sure. So this is something that I would say pretty recently, APA has recognized as something they should be working on. So as an organization, this is something that's being thought of and pursued, right? So we're actively looking to speak with folks and figure out how how to do these, but it's not something that's been done to date. So I can tell you that it's in the thought process of the organization, but I can't say it's anything that that's actively been executed on.
Got it. And just to take a step back, we're talking about IRS Form 8609. That is once you receive your 8609, that's you have received the tax credits, you're completed with all the audits, and please correct me, as a NOAA guy on the panel, please correct me if I'm wrong. And so once you receive that, then you have to get your first one. But a question on the QAP, and many states have this on the qualified allocation plan, is have you received an 8609? That's the definer of have you done a previous LIHTC deal. A recent deal in the case of Virginia, as Ben alluded to earlier, you have to not only have done a LIHTC deal, but have done a recent LIHTC deal where you've received the 8609. So just a clarification point there.
Just say that if any of you interested in getting into that and all that, that picture was taken just last month and that was after the public tax credit closings. So those of you who are embarking, you may want to get out of affordable. Now it's been great, but it really is, you learn the acronyms and the tax forms. It really, there are days when you wonder, life is too short to be, but yeah, that's the big, they can make it a lot easier to do with the IRS and even the development, it could be a lot easier to develop this stuff than it is. And I don't know if will ever change, but
there's many difficulties. I think what might also help is to define the risks, right? So when we're talking about LIHTC development, you have allocation risk, whether or not you'll receive an allocation. There's a distinction between 4% and 9% tax credits. In many jurisdictions, in most jurisdictions, the 9% are competitive. In many, the 4s are switching to being competitive, even though they're non-competitive, which essentially, if you hit this AMI, you will receive, this tax credit, and then you model it. Generally, once you receive the tax credits, you could sell it, and you sell the tax credits for however many cents on the dollar. I don't know, 85 to 92, 95, somewhere range. You receive that as cash up front, and now you owe the tax credit investor, you owe them annual tax credits. So you're also saying to them that I will comply with these rent restrictions in exchange for providing you the tax credit. So they have risk that you're going to comply with the tax credits, right? If you're all of a sudden you change it to a market rate property, you lose the tax credits, and it's not just you because you have the investor's cash, but they're taking a hit as well. So just a couple of defining points of how LIHTC works in 10 seconds. So I want to also talk about naturally occurring for a second and the complexities. Historically, LIHTC deals used to be a lot easier because we've seen a lot of things that have happened recently, including construction cost increases, right? Including significant interest rate increases, including a doubling, 3% to 8%. Interest rates have gone up tremendously. So how do you get a deal done if your top line is restricted? You cannot charge more than a certain amount of rent. We're talking about real estate taxes increasing, insurance increases. All of these are very recent topics. The general answer is if the market bears, you can raise you can raise rental rates, but you can't because they're restricted. So historically, you used to have it where you would get an allocation and then you just get debt. LIHTC deals used to be easy, maybe early 2000s. Correct me if I'm off on the timing, but 1986. And so it used to be where the capital stack of LIHTC deals was fairly easy, not as onerous as it is now. And the naturally occurring affordable housing deals are mimicking the complexities of a LIHTC capital stack. So Myron, I'd love to just get your feedback on this. You work primarily on naturally occurring affordable housing and the added complexities, which now even have, specifically in the district, DHCD preservation funding and some of those other things, which adds complexities into modeling. right? How am I modeling all this stuff with the tax credits? What, have you seen an increase on the naturally occurring affordable housing interest? Have you seen LIHTC developers that are also doing NOAA?
Yes. The short answer is yes. There has been an increased interest in NOAA deals, especially from the LIHTC side. But all the complexities that you've talked about have made things harder, just like it has in these other areas. I mean, it's the complexity that I've seen though, on the capital market side has been, I think the best way to describe it is that I feel like a lot of the capital markets feel like they're waiting for the bottom to fall out on the broader marketplace, because the belief is that they'll be able to get their hands on assets for a lot less. And then on the financing side, there's a decent amount of retrading that's been happening, which has caused people in the NOAA space to have to seek a lot of gap financing. And I've seen a lot of that over the past year and a half, really. A lot of that. So there is an increase in interest in the NOAA space. I know there's some potential legislation that's designed to hit some of those missing middle AMIs, the Workforce Housing Tax Credit Act. That is, it hasn't hit the floor yet, but I know that they are working on trying to get that passed ideally this year, which will deal with 60 to 100% area median income, that missing middle. Just to put some numbers around it, in DC, AMI, 100% of AMI in DC is 110,335. So the 60% AMI level will be people making $66,000 to that 110,335. That's what that legislation is designed to deal with. But there is definitely an increased interest in the NOAA space for sure. However, there are still those challenges, and I would say chief among those challenges is the increased financing cost. That would be the probably the biggest financing challenge, because it's made deals that might have penciled a year or so ago, not pencil now, unless the sponsors are able to come either with equity of their own or source it from the marketplace. And that's been the biggest challenge that I've seen alongside this increased interest in the NOAA space.
Capital stacks are a really interesting thing, particularly in the naturally occurring and LIHTC spaces. Charles, would you mind just walking us through what a typical, I'm scared to say typical because there's no such thing as typical. It really varies based on the jurisdiction, based on the funding type, 4%, 9%, but in comparison to 65% LTV debt, 35% equity, what does a typical affordable deal look like?
Sure. So let's just break it into 4% and 9%. So 4%, as Ali stated, is the non-competitive tax credit that's paired with tax exempt bonds. So the way that would work typically is you'll have about 30 to 40% in debt. You'll have about 30% in equity and about 20 to 30% in subsidy. Now, what subsidy means is that's subordinate local government funds, usually, sometimes it can be state funds or even private or philanthropic funds. Something that is below market rate debt usually is what's filling in that subsidy piece. For 9%, you tend to have somewhere around 20% debt. The equity is a lot more valuable, which is why it's competitive at about 70% of your capital stack, and then about 10% of that being subsidy on the 9% side. So that's typically kind of an affordable capital stack for either a 4% or 9% on the LIHTC side. I'd like to just add one note to what Myron mentioned in terms of things creating difficulty for NOAA, insurance, right? So what all of us are seeing right now is crazy increases in insurance costs. And the reason why is it's very difficult for insurance companies to model what's going to happen. So that 500-year flood is now happening every 3 years, right? The 100-year event is now every year. So if I'm an insurer and I've got to figure out what my loss reserve needs to be, I have no idea how to model that because we're in a completely new climate environment. So just to give an example, we purchased a property last year and the insurance cost between what it was to now went up 6x. So you're seeing issues where properties that may have penciled or where people are paying rent are operating in the negative because insurance and capital costs. So that's one thing that's really pushing folks. So, like we have a question. I don't know.
I just want to ask.
Yeah, yeah.
Where was that property? Is it the Northeast or was it Florida?
No. It was in Maryland.
Maryland, 6X.
Non-coastal Maryland.
No, the DMV.
And you can't increase rents. So if you're operating in the red, what do? Do you continue to fund operating losses, deficits?
Well, thankfully, we're not operating in the red, right? So thankfully for this property, we were able to cover that. I mean, we underwrote the property very well, so there's not a loss on that property that we're still operating, well. But it is something to just be mindful of as folks are pursuing NOAA deals. As
Mhm.
you're looking at this, insurance costs are they're a barrier that it was not as huge of a concern 4 years ago
Mhm.
as it is today.
In comparison, so we just heard from Charles what a typical capital stack deal looks like for LIHTC. Myron, what does a NOAA capital stack look like?
So, a NOAA capital stack deal, I mean, they'll usually need to come with anywhere from 10 to 20% of equity minimum in order to make that work. And that depends essentially on where your senior financing is going to be. Tying into what I was saying earlier, given the increased cost of doing a lot of these deals, what's happening is borrowers are having to go elsewhere to try and find that equity in order to make those deals work. I mean, that's been the broadest piece. Impact funds are stepping in, but their return demands are going to vary, right? Because they know that they can charge a 12% or 16%. Because they know that they're the primary game in town as far as attacking this particular market. Otherwise, as was said earlier, you'll end up having to go to the hard money sources and, hope that you can essentially make it back when you end up stabilizing the property. But it's very difficult. It's very, very difficult right now. There's no way to, the interest rate pop has been especially onerous on this section of the marketplace.
Makes a ton of sense because you're not receiving the benefits that you do on the LIHTC side. You're essentially free market. Maybe you might get a couple of bips shaved off from Fannie and Freddie because of the affordability component, maybe. However, or our friends in the banking community might have a target, particularly the community banks, our friends in the CDFI space. But everyone has a cost of capital, and it's all businesses that need to layer in spread, and the end user gets that interest rate. And so that's really what's happening now. And a lot of deals are being shelved, also on the LIHTC, also on the naturally occurring, I think every deal really. Switching gears for a second, I want to ask Scott, what are the challenges and opportunities in funding affordable housing projects, and how can these be navigated?
Sure. So in terms of the challenges that you see with affordable housing transactions, I think that it's really the challenges that folks have been seeing across the market. We see rising interest rate costs, rising construction costs, and that makes it much harder to fund transactions. So some of the opportunities that have come out and have addressed that and have made it possible for us to fund deals in DC were that we had monies from the American Rescue Plan and the state and local fiscal recovery funds. So that was a boon for the industry. In DC, we made a commitment to funding affordable housing, and I think in the last 2 years, it was a $300 million commitment for the Housing Production Trust Fund. And last year, it was $400 million. So it was an enormous amount of money coming out. So that's been kind of a challenge and an opportunity that's paired with that. The other good thing that I see is that there are opportunities right now with changes in legislation. There's a bill right now that's in the House. I believe it should be approved shortly, where it would increase the amount of 9% low-income housing tax credits by 12.5%. So that would be fantastic. That would be another for DC. That would be about $3.4 million of actual LIHTC equity that could go into a transaction. And then additionally, they're looking at increasing the tax exempt bond issuance capacity by about 40%. So that's another thing. I know you were saying a lot of states right now have limitations in terms of being tax exempt volume cap constrained, hitting that ceiling. There's 13 that I know of right now. And if this legislation were to go through, it would be incredible for the industry, and it would enable a lot of these transactions that have figured out their subordinated debt, figured out their other sources to be able to proceed now that there's the tax exempt volume bond cap available to allocate. So challenging market, but I think that everybody's doing what they can, and it's great to see that Congress is stepping up and doing what they can to get these units built.
I think tackling affordable housing involves many different, a multi-pronged approach. So I think it's also worth defining the differentiation between the creation of affordable housing and the preservation of affordable housing. Ernst, would you help us with the definitions across those two and what you focus on?
So we do both. Preservation is in my opinion easier because you don't have to deal with sort of like new construction risk. And we use a trick sometimes where the value of the building, if it has like sort of like an ongoing affordability requirement, someone can't just sell it for market rate, or right. And so the value of the building at times, like especially if a nonprofit has owned the building or CDC had owned the building, the top value of that building could be a soft second. So it's part of that 20 to 40%, capital stack. It's the value of the building itself comes in as a soft second. And then you pay that through sort of like, if there's available cash flow, you get a markup to market. And so one of the things with the market going up, HUD will look at the building every 3 years, I think, and they do this assessment. And if all the rents around that building have gone up, they redefine what the market rent is, and that's a markup. I don't like to say marked down because that's like a curse word. Because if you get marked down to market, that's when you're in trouble. And so we like the preservation because you could use the value of the building to be part of that capital stack. If it's new construction, then you totally are dependent on sort of like your local and your state authority, wherever you are, helping you fill that gap. So affordable housing is nothing like market rate housing or even naturally occurring affordable housing because there is no cash flow really, right? It's a nominal cash flow. And if you're smart, you put that in escrow for a rainy day, right? So you're not making money traditionally where, you're getting a ton of cash flow. You get paid a developer fee, right? There's a paid portion of it, and then there's a deferred portion of it. And the deferred portion, you're supposed to kind of pay it out to yourself over the next sort of like 10 years. And it's really slow cash flow. Maybe you're getting $172,000 and it's like a $20 million deal, $26 million deal, but you do get paid a developer fee for doing it. So, I'm trying to describe a lot of different things, but ultimately it's easier to do to preserve affordable housing than it is to build new, but we have to get creative in creating new affordable housing, right? So innovation is the way we're going to get out of this, right? And so in Baltimore, one of the things we're doing is we're doing like a true public-private partnership. Baltimore has the Pratt Library, right? So the Pratt Library, after 17 years living there, and I realized it's not just one library. It's like a network of libraries, right? And so, I would go around and I would see like these single-story, obsolete Pratt libraries in the neighborhoods, and I'm like, coming from New York, and I'm looking, and I'm like, there's all these air rights that aren't being used, right? And so one of the things that we're doing, and it took a lot of really smart people in Baltimore to kind of come together, including the state senator, to kind of say, maybe this could be a model. And so what we're doing in the Pigtown Library is we're knocking it down and we're going to build a new library that's 2 stories, but then above that, we're going to build 6 stories of housing. Right. And so that kind of creativity, when you say there's no land, you've got to start looking at what are some of the public assets that are underutilized right now. And then start thinking about how we get, you know, a lot of people in Baltimore or in DC, they love parking, right? And I always say, if you are 3 subway stops from your car, that's a good parking day. Like, you don't have a really vibrant, great city until you have a parking problem and people are forced to kind of get out of their car. And so DC has to have more of a parking problem to start thinking of innovative ways to, you know, and not be afraid of density, because the instinct is, you know, to be afraid of density. The other instinct is to say, okay, we don't have workforce housing, people are losing their homes. The other instinct is to sort of like punish the developer. And New York City is doing that right now. New York State, they're saying, you know, you can't raise rents. You can't. And guess what's happening? People are bringing back the keys, right? And they're saying you could have it. Here you go, bank. Here you go. And then the bank is turning around and saying, here you go, city. And then no one's, you know, if you've ever seen how public housing, you know, people complain about how developers run things. How does the public run things? Like 110 times worse. And so the instinct is to kind of make it someone else's problems as opposed to like innovating out of it. Or what DCHFA is doing is saying, how do we get more people and how do we fund them? How do we get, I mean, think about it. DC, how small DC is, has 400 million in the housing production. I mean, like when I was doing a lot more active things in DC, I think it was 100. And when it went to 150, we were like, oh my God, look at all this money. But to get to like 300 and then 400, that's a real commitment. Because, you know, this is a place where it could get to like $1 billion. And other places that are much bigger, they haven't figured this out because they're not committed to it, you know, and they talk around the issue. And so I would say, go ahead.
I was just gonna say, thanks, you're talking about the buildings in DC earlier.
Mhm.
My earlier question is, we actually have a housing production project, right?
Mhm.
Mayor Bowser, it was a big sort of deal for her to step up 5 years ago and say, we're gonna try to build this amount of housing in 5 years' time. And it was so successful and has been so successful that in this last election cycle, every single candidate was basically asked, what's your target gonna be? And there's very few cities where public figures are willing to kind of go on record and say, from a production standpoint, this is the amount of housing I'm going to try to see built during my term.
Right. And so New York, they come out and they say, well, we're going to build 200,000 new units. And what they don't say, if the sentence kept on going, how many units are you losing? They're losing 400,000 or 500,000. So what's the point of building 200? It's like bailing out of a ship that's like already underwater. I don't know if I answered the question.
No, you did, absolutely. So you did. What's important in that is everything's important, but specifically that we're losing affordable housing. So it certainly is on the creation of affordable housing, but in addition, we've got to retain the existing affordable housing. Our friends in the brokerage community right now have packets put together and offering memorandums that say the extended use period is coming up. Just kick everybody out. And then you've got $1,000 per month spread in each unit's mark to market. So forget the whole affordable housing game, just buy this property and then kick everyone out and then just roll it to market. There is legislation that prohibits that. And there's ROFRs and all types of things, but equally, we should look at the preservation, the retention of affordable housing in addition to the creation of affordable housing. I want to ask that question to Ben as well. Do you all do both creation and preservation? Or do you focus on the ground up only?
Yeah, we mostly the ground up. But to the point about the extended use, because I don't know how many brokers package you've seen, whereas they sell that whole,
Yeah.
you can mark to market. W- We make commitments to the jurisdictions giving us the gap financing, primarily Loudoun County and Montgomery County. We commit to at least 75 years affordability. So even after, right, and so for example, yeah, yeah. I may be, I don't know. I'm very young. Don't let the gray hair fool you.
We got to
No,
see a
but-
picture next month, right?
but-
That's the.
But like, so the deal, we partnered with APA, right? So after the 15-year compliance period, APA's gonna buy it. And they're gonna keep it affordable in perpetuity. But finally, these jurisdictions are saying, hey, if you want our money and the way most of these jurisdictions do, and somebody talked about the capital stack, these are cash flow notes, so they're a soft stack. So basically 75% of our cash flow goes back to the county in terms of to pay back. And we have to be able to show that it'll amortize over 40 years. And typically what's going to happen is when an APA buys it, they're going to refinance it and take out the county. But we commit to long periods of affordability because the jurisdiction saying, hey, you can't just have it for 15 years and then make a windfall if you want our low interest money. So that's one way to sort of keep some of the affordable, as a way to sort of beat that system. You mentioned I'm vice chairman of ADOB, which is the Affordable Dwelling Unit Advisory Board. And Loudoun County has it, and this deals with the for sale piece, and we debate this all the time in terms of making changes, because the way the system is now, if you buy in, and I think our waiting list is 400. So like you could sign up today and you may never, right? You could sign up as a newly minted teacher at age 22 and you may get your house when that's how much the demand is, but you only have to own the house for 15 years and then you can sell it at market. Now you have to split half of that and half of that of the ups go to the trust fund. But what we're debating is that it's got to be longer, right? Because even if you're getting half of that money on a sales price, all right, great, the trust fund's gone up, but we've lost now we have a house that was affordable, not anymore. And we're losing more for sale housing than we're building. And so on a rental and a for sale, I think if you look, and you probably know, we're probably not gaining, right? We're probably on an annual basis nationwide, we're probably losing affordable housing, but the need is getting greater. And so you got to make commitments for longer. And you talked about creativity, and just real quick, we're doing a deal in a school, Loudoun County's first multi-classroom school built in 1940. It's been dilapidated, fallen apart, sits on county land. County's giving us the land. We're going to put 9 units in the school. We're going to put a building behind it with 64 units. We're also rehabbing the rec fields that have been dilapidated. It's a part of the county that has a huge Indian population. We're taking what was a soccer field and making it a cricket pitch. And all it's taken for the county is they're just giving us the school, right? And that's the kind of thing that you need to, the counties need to look at their, and it's a small site, and we're only putting only 73 units, but it's still 73 units on a parcel that wasn't yielding anything. And that's the kind of thing, you talk about libraries. That's where these local jurisdictions have to get to and find creative ways to utilize their real estate assets for more affordable housing.
That's a great layup for the next question that I had. How have recent housing policies at the federal, state, and local levels impacted the availability of affordable housing? Are we looking at unique things like that where the county or the city owns a significant amount of real estate anywhere, and there's surplus land anywhere, any jurisdiction has it, you can look it up. How do we tap into that? How do we access that? How do we hold our leaders accountable for redeveloping that space and not putting the onus on the developer's shoulders only? Anyone can answer that.
I think in terms of things that have happened in DC that are talking about housing supply, trying to ensure that we have these entitled units, one of the things that they've done is in terms of updating the master plan and updating zoning, they went through and they identified that there's a lot of churches that are out there that have older facilities and they have land that could be prospectively redeveloped as affordable housing and provide these churches additional funding for their congregations that may not have as many folks going there and may not have the fundraising capacity that they had in the past. So what they're doing is they're saying, let's talk to these churches, let's ensure that we can work through and get these sites upzoned during the the map process and during the zoning process of updating the zoning code. So we know that these sites can be redeveloped as affordable housing in the future. And so we've had a few projects that have come through our pipeline. One that's very interesting where actually similar to what you're talking about with the Pratt Library, they're going to have concrete church on the first and second floor. And then above it, they're going to have seniors housing above it. And the facade that they planned, it's a beautiful building. And they're actually planning to have stained glass on the facade. So it looks like a church. So I think that's something that's amazing that's happening. And then in terms of additional financing, new policies that have come out, a lot of states are looking into something called state low-income housing tax credits. So it's similar to what's going on with a federal low-income housing tax credit, but rather than having it be a tax credit for federal income tax, it's a tax credit for state income tax. So in DC, it's a by right credit right now. And so for every dollar of federal low-income housing tax credit you get 25 cents of state low-income housing tax credits. So that's really helped to move the needle. And it's made a lot more transactions pencil. And it's something where South Carolina has had one. Really all over the nation, folks are viewing this as a new tool for affordable housing production. So lots of really good things happening state and local level.
Yeah, I'd like to touch on something Scott brought up. So APA has done several deals with churches where we partner with churches to redevelop their sites and then do affordable housing along with them, including our newest development, which is coming online next month. So it's Unity at Ballston Station, which was a partnership with Central United Methodist Church, where we took their aging infrastructure. You know, a lot of churches have this, where they have aging infrastructure and a declining membership base. And so what happens is they need kind of new facilities to help them kind of bring in new memberships and kind of revitalize their stuff. So that development is a new 30,000 square foot church and daycare facility, along with 144 units of affordable housing located directly across the street from the Boston Metro. So it's Unity at Ballston Station. And if anybody is looking for affordable housing or wants to, the wait list is open. So if you know anything about it, if you want affordable housing, you need to get on the wait list pretty early. So that's coming up right now. So that's one project. And we also worked with the Arlington Presbyterian Church, where their site was, we redid they had aging infrastructure, similar kind of situation, helped to reimagine their space and put a church on the bottom along with community retail, where there is Kitchen of Purpose VA is located in there, and they offer kitchen incubator, food incubator space for small and upcoming food entrepreneurs, along with 178 units of affordable housing. And then additionally, just to throw it off, also one more in there, we work with nonprofit organizations that also have, additional land or aging infrastructure. And with the Post 139, American Legion Post 139, we redid their space to the first Veterans Preference Development in Virginia. With that, they had, again, aging infrastructure, declining population, rebuilt the entire Legion, and I think it's 6,000 or 9,000 square foot space on the first level with 160 units of affordable housing above it. And I won, I think, ULI's Project of the Year last year. So we're really excited about that. So
That's awesome. Congrats on that. I've actually toured the Ballston site with Charles. It's a beautiful project. I remember Charles telling me some of the unique reactions to the challenges of development there. So it's wonderful. Myron, I'd like to get your response to that. What can our leaders do at the federal, state, or local level in terms of impacting the availability of affordable housing?
Sure. I think I talked about this a little earlier about that Workforce Housing Tax Credit Act. I think bringing that to the floor and passing that as soon as humanly possible would be a gigantic step towards increasing the availability of affordable housing. I mean, you were talking about New York and some of the challenges there as far as, they'll say they're creating 200,000 units, but they're losing an additional, 400,000 units. And that kind of ties back to, what I said at the top of the panel about incentives, right? If I were to look at, and I'm just using New York as an example, and we'll compare it to Washington. There's height restrictions in Washington. We all know this. You can only build up to a certain point, so you can't materially alter the skyline. That doesn't exist in New York City, as we all know. It gives us, the skyscrapers that exist, but it also disincentivizes that creation of non-luxury, affordable housing, workforce housing. It disincentivizes that. You were talking earlier about the Housing Trust Fund. I remember when it was first announced. I think it was like 2016 or 2017, something like that, when it was first announced at that $100 million level. And now it's at 400. I think they're trying to get to $500 million and beyond. I think mirroring that sort of intentional direction of dollars is just so critically important. Mirroring some of the work that you guys are doing at HFA to try and solve for those balance sheet issues, to try and solve for those pre-development dollar issues, those liquidity issues, what you guys are doing, with the fund and co-GPing with different people. Those policies that mirror that kind of activity, I think, is critical towards creating affordable housing, because there are developers who want to do the work. There are developers who are acutely aware of the challenges that exist as it relates to the space and are equipped to tackle it. But they need help on the liquidity side, and they need help on the incentivization side in order to make that happen. And lastly, I mean, there are platforms that deal with economic empowerment that are focused on helping the tenant base within the affordable housing space. Because one thing that gets tossed around a lot, there's a lot of language that goes on relative to, the affordable housing space, relative to things that try and tackle various types of inequality. And some of that language is really offensive, quite frankly. As if there are people who live in these spaces that don't want to try and make the most of their opportunities, right? The idea is that people are trying to simply take advantage of government subsidies and government programs and have no desire or no incentivization to try and be better. When we all know that it's not true, but it's utilized to try and choke off funding. It's utilized to try and minimize funding. I mean, a few weeks ago, this never actually went to the floor, but there was a theory that it was going to happen in the House, that there was a bill that was going to go to the floor looking to reduce the funding that goes to CDFIs, right? Like, didn't happen, thankfully. But the idea behind that is, of course, well, we're spending so much money on this, right? There's so many billions of dollars that are going to these institutions to prop up this sort of housing. Can it be used on other things? So, and that was a lot, but yeah.
No, that was a lot. And thanks for that. This is a good segue into the next question. I want to stay with Myron for a second. Impact of gentrification. How does gentrification affect affordable housing, and what measures can be taken to mitigate its negative effects?
Well, I mean, the short answer is it pushes up values to make longstanding housing unaffordable for longstanding residents and natives of different areas. I mean, that's like the super duper short housing. I mean, the short answer, excuse me. You guys are kind of both both of you guys are essentially doing this, where you're looking to lock in that affordability over long periods of time to try and mitigate that risk. And I think that's critical, right? Because people are, I mean, you mentioned earlier with brokerage packages, people are watching for when these covenants and when these time periods expire. They're looking for it. And they're looking to pick up these properties. They are counting on increased cost of capital. They are counting on shifting interest rates, and positioning longstanding owners of these properties to not be able to hold on to these assets so that they can scoop them up. So, you know, all of that is there because there's incentivization that comes from gentrification.
Charles, did you want to follow that up or?
I just want to touch on one issue related to gentrification, and this is kind of like slightly outside the scope of this because it's more smaller property related, but it's the issue of tangled titles. So if anybody's ever inherited property or, you know, property passes down and you now have multiple owners of it, this is one of the big issues that prevents folks from, one, being able to access dollars that are allocated to folks in terms of being able to fix or rehab or improve properties, but two, makes them especially vulnerable to people coming to poach properties or pick them up from tax sales. So it's something that I think a lot of municipalities and a lot of other folks should really focus on. And additionally, there's another issue, depending on the municipality, there's deferred taxes that seniors may get that may come due at the time that property's transferred. And that also makes people especially vulnerable to gentrification. So I think there's a lot of tools that can be put out for that, but that's something I just wanted to, I saw a question on gentrification. I was like, we got to touch on this.
Thanks for that. We are in Georgetown University, so this next question I'm going to ask Scott is a very timely question. How can educational institutions such as Georgetown University contribute to solving the affordable housing crisis?
Right. I think that I'm going to give a shout out to somebody in our audience here. I think that the things that we do, first, we have great education platform for folks to learn about affordable housing and get the skills that they need to join the affordable housing industry when they graduate. I think the second thing is participation in challenges and things like that for folks to really understand what goes into an affordable housing project and how that works to kind of get the real world sense of what a deal looks like. So I've been talking with Kevin Rowley and some other folks on his team. Christian Prima are two of our guys from the Georgetown program. They're participating in the HUD design competition. So with that, they're looking to redesign a public housing site in Madison, Wisconsin. It's been a really interesting project, and they're going in and they're partnering with architecture and planning students from Howard University. So I think that that's one avenue. Another thing that I was doing some research ahead of this, I was looking at what are universities doing to address the affordable housing crisis. One thing that came up that I thought was really interesting is Howard University is actually, they built an affordable housing project. In 2017, Howard, they went through, they got their master plan approved for their campus. And there were concerns about gentrification and how they were going to ensure that Pleasant Plains wasn't gentrified by the changes to their campus. So what they did is they committed to building an affordable housing community with 50 to 100 units with an AMI restriction at 30 to 60% of AMI. So I think it was in 2020, I believe, that they acquired the site, and they recently wrapped up with the renovation of an ACT rehab project. I believe it's, I'm blanking on the name. It's I think it's Howard Commons, and it's a project where it's going to be, it's 80 units at 60% of AMI, and they partnered with Amazon Housing Equity Fund. So I think that we can try and train all of our students to go out there and make a big impact, but some universities are actually going out there and building affordable housing themselves. So I think that we can always try and do more, and I think that these are the conversations where we stir up those ideas and see what we can do as a group to try and solve the crisis.
Let's stir it up. I love that. Go ahead.
Well, I think, and this is not to get off because I know we're running out of time, but I think the universities and maybe this is because I'm a dad of college students. The universities have an obligation to have their students give a shit, right? I mean, whether it's affordable housing, whether it's the client, like, and it's great to go, work and build fancy glass buildings and rent them for $5 a square foot. But like, we need folks to be educated in a way to actually care about more than just the dollar. And I don't mean to take us down that path, but it really is just sort of, some of our best partners, and Richard's one of my partners here, but we partner with some folks, and it's interesting because we partner with some big builders who we're just sort of a necessary, right? They don't really give a shit about affordable housing. But then we also partner with some master developers who are they get it and they're behind it. And some of it is honestly, they've made their money when they were young and they were selling the fancy glass buildings, and now they want to give back. But I think we need to start having people give back early. And that's that's not just in the affordable housing, it's in whatever career. If you go into law, if you go into, science and, don't, you don't all have to be environmentalists or affordable housing developers, but I think we get people thinking that way. So then when we come in front of a city council or something, then you get like-minded people who aren't automatically going to be dismissive of affordable housing. And so I think the higher education institutions sort of owe it to, more classes in ethics and things like that, really, the touchy-feely stuff when I was at UVA, or, everyone didn't want to take organizational behavior. I thought organizational behavior was probably the most important class I ever took at business school because it touches everything. And so I think we need to start minting more good people, right? I mean, that simple as that.
Georgetown, you hear that? Start minting more good people. We have a question in the back.
Up and coming developers or small to medium scale developers to be able to fund their projects.
So I'm just going to reiterate the question and then anyone can answer it. How accessible is the Amazon Housing Fund for emerging developers? Myron, do you have any insight?
I mean, it's a process, right? It's, there are some nonprofit developers that are able to get on that, to get access to those monies, but I mean, it's a process. It's not like any of these things that we've been talking about. I mean, there's an application and evaluation process. I believe their fund had, maybe someone can correct me, I think they had like 2 billion or something that's supposedly dedicated for this. But yeah,
I think, and we're still waiting for sort of Amazon Fund 2.0 because that original commitment, I think, has all been sort of allocated and spoken for. But I think to my point, it's still a process to get access. I mean, the folk, I think you guys got some for your the big.
That's correct. So our exchange at Spring Hill Station, which is a pretty cool development. It's in partnership with Fairfax County. We've got a whole 30,000 square foot, maybe a little bigger community center and 516 units of affordable housing. We broke ground in December 23. So that's going right now. And Amazon made a substantial commitment to that in the tune of about 55 million, I believe. But in terms of your specific question, in terms of what is Amazon doing for small and emerging developers, I don't know the answer to that, but we have worked through that process with them.
I'll chime in. I think that this doesn't directly answer your question, but I think it answers the heart of your question. It seems like for Amazon Housing Equity Fund, from the projects that I've seen that come across my desk that have that funding, they're generally large projects. So not so much for emerging developers, but I think the great thing about being in DC is that there's a lot of fantastic CDFIs that are here, and there's been a lot of interest in supporting emerging and minority developers. So I think that there are cohorts of folks that are getting trained, and there are proprietary funding sources that are out there for folks that are interested in those. So the ones that I can think of are Black Developers Capital Initiative is one for up and coming developers. There's another one with Capital Impact Partners. They have 3 tiers of developers where they have folks that are generally novice, an intermediate, and then a much more experienced group. But I think that there are other avenues and other CDFIs that are passionate about this, that want to get the money out there and they want to build capacity. Amazon might not be the right road, but there are other roads to go down.
I think, Bob, did you have a question?
My comment, and I think it piggybacks off of what Ben said, is that I think our region needs to give more opportunities to analysts to be in affordable housing, like taking people who just have an interest in doing the work. Having lived in DC and also lived in Northern California is a little unique because there's like 4 large nonprofits. So there's people coming out of Berkeley who have decent GPAs and they just said they want to do affordable housing so they can go work at Bridge Housing or Mid-Penn or Eden Housing. And I think on the East Coast, it's like you got to have 3 degrees and 5 years of experience to become an analyst, right? And so I think Georgetown can have the class, Maryland's program has an affordable housing class, George Mason has an affordable housing class. We can build a pipeline of people who want to do the work, but then they can't find a job, right? And so in some instances, it's easier to become like an investment banker because you've shown the aptitude to do work than it is to be in affordable housing. Kind of similar to the same, I feel like we have the same cycle as trying to be an affordable housing developer as to be a affordable housing employee. It's like, how many tax credit deals have you done yet when you come to the interview process, right? And now you get discouraged and you can go be analyst at insert any market rate development shop because they're like, all right, you're smart, you got 3.5, we'll show you how to do it. You know, I think sometimes we're shooting ourselves in the foot, you know, always looking for the more experienced developer.
That's a great point. Affordable housing is difficult. The complexities of it, in addition to having to have the required capital, it's also really difficult to go through. We talked about the many touch points of capital stacks. I remember looking at a deal that had 12 unique pieces in the capital stack. So it's a very complex process. I agree with you entirely. I do want to say as a quick plug that for folks that did get in the analyst role and take deals from start to finish, there's a fund here just for you. So you can do a deal having learned all of that experience. So again, a great point. I want to pause for a second. We're coming up on time, and these are all great discussion points. I want to give our panelists an opportunity to just talk about anything that they want to talk about. So again, I appreciate you all being here as a personal favor to me. But I want to give you the podium to talk about the fund, talk about initiatives that you have within your organization to progress affordable housing or anything else. We'll start with Scott.
Sure. I think, Bob, your question was, it's like you were asking for me to talk about this. We are bringing on a new underwriter for our agency. So I think that we've got lots of really pumped up people in the crowd here and on Zoom. So if folks are interested in DC Housing Finance Agency, the job listing should be posted by the end of this week. So if you're interested, we'd be happy to talk more about the role and more about what's going on with affordable housing in the district. And then in terms of the work that we've been doing, we're really excited about this pre-development loan fund. I think that's something that we've been working on. We're hoping to push that this spring. And I think really what we've been doing at this point is looking through, trying to understand all of the pre-development loan funds that are out there for emerging developers. We found about 15, and we're trying to hone in on how to administer that program and fill that gap. So something we're passionate about. I think that's really what's on the cutting edge with our agency. Yeah, that's it for me. Charles, if you want to jump in.
Sure. So I think what I'd like to touch on is the importance of community and the resident engagement, right? So at the end of the day, we are building housing for people, right? And we look to build housing that helps somebody improve or encourage or sustain their entire life or be a holistic opportunity for some folks. So I think one of the best things and most rewarding things about doing this work is being able to see the change that having an affordable, safe, secure home has on the impact of an entire family. So I remember when I finished my first project, right? This was a little 30-unit rehab that I did a long, long time ago. And I got to watch and help the families move into the building. I was like, oh man, like this is a game changer, right? And it just changed the perspective of all the headaches and all the other drama that you go through in this business to make projects happen, to see the rewarding impact that you have. And just in terms of APA, one of the big things that we focus on as an organization is resident services and how you engage the entire resident and the entire resident's family in that. So our largest team in the organization is the resident services team. We have folks stationed at just about every property where we have specific programming engaged to help folks move through things. So I mentioned a veterans focused project. We have veteran focused initiatives there based on the ethnicity of the neighborhood or the area. We have different programs targeted to what the individuals need. So I think one of the biggest things is we never want to lose focus on the resident and the resident experience. That's the core of what we do and the core of who we're serving. And that's just a big initiative for us.
That's a really important point because we can get mired in spreadsheets and formulas and applications and allocations. But all of this is squarely around the resident. More so in the LIHTC space, the concept of wraparound services. It's a very interesting thing. And I'm going to ask Ernst to talk about, he said something very impactful when he gave the keynote speech down in Richmond at a conference that I was at, where he's looking at a unique way to actually fund a stock trading. Please, I'm entirely butchering it, but for the children who live in the properties that he owns, he's seeding capital and donating and investing capital annually for the children. Ernst, would you want to talk a little bit more about that?
I'll make this my final word too. So what we've done in Chicago, we bought a 296 unit apartment complex. And we found out there were about 288 kids that lived on the property. And so the whole kind of concept of like gentrification, it's the gentry is moving in. It has nothing to do with race, right? It has nothing to do with gender. It really has to do with people with money that are moving in, right? And we've just turned it into this thing where most Black communities are afraid of gentrification because it automatically means not them. Right. And when I've taken like really smart people from MIT and like I've said, is this gentrification? And they say yes. And it tends to be like a bunch of hipsters that have no money. Right. And then when you take them to like, Baltimore has like different pockets that have lots of federal employees, like people who have money and they happen to be Black. And I say, is that gentrification? And they say, no, it's just so we've got to be careful with gentrification, right? It should belong to everyone. Everyone should have the opportunity to this is why meritocracy is exactly to be a gentrifier, right? Or to have wealth, right? It's just everything stacked up against certain people in terms of being able to have wealth. And that's why we're paranoid, right? Because we think if we have it, someone's going to come and take it. And there's plenty of examples of that. And so one of the things we did for the kids that live at this property in Chicago is we set up brokerage accounts for every single kid at the property. And so what does that do, right? It's like when a kid turns 18 at our properties and they get a job, now mom is makes the household, they become part of the household, they go on the lease, right? If they make a good, and we've had this happen. We had a young lady who, graduated from high school, got a job from UPS, made some money. Mom is now overqualified or her income is too high. And so kid has to go get their own apartment. But how do you get your own apartment when first, last security? Or what if at 18 you decided you wanted to go to college? And then how do parents control their kids? Like upper middle class or even just middle class families, the way they control their kids is with money. They incentivize them to get good grades. If you get an A, you get this, you get a car if you do this. And most low-income families don't have that ability. And so what we wanted to do is potentially like give those families that ability. And so if the kids are getting good grades, we reward them by funding their account. And on a quarterly basis, this company is called Early Bird IO. And I learned about it from one of my students at Booth, who was an investor in that. And so it's something that we want to roll out to all of our properties. where we start to partner with their parents and we say to the parents, if you put, the minimum is like, $15 a month. If they do that $15 a month that they invest in their kids, we'll match that. But then beyond that, as they get good grades, as they volunteer, we're going to give them more money so that by the time they turn 18, there's a little nest egg there that they could use to go to college or get that first apartment and be able to put furniture in. Is like some of these folks, if they get that first apartment, there's no furniture. They're living on crates, like like they can't even afford IKEA. And so at the end of the day, I think we should also focus on not just providing this home, but how do we give people the opportunity to build wealth and know how to build wealth, especially at a young age. And so if at 10 years old, you're going to these quarterly things and Early Bird is telling you about investing and you could ask questions about what they invested in for you, by the time you get to 18, hopefully you get that. And you don't have to go to college, but if you do, you could just keep building on that. And if you don't, you've got $30,000. You've got something to start your life with. And our buildings can provide that, right? If we invest, and it's funny because I have partners that will give $1 million non-refundable deposit to like a slumlord to buy a building, but they won't give $25,000 a year to fund something like this because they're like whether it's they're disillusioned or sometimes I get egg in my face because some of the parents, they get mad at me for taking the money and using it this way because they're like, you didn't fund our barbecue this year and you took the money to do this. And so I got egg in my face because I was like, why aren't we doing this? It's going to cost us $50,000 a year. That's nothing. That's a rounding error on some of these deals. And the parents were like mad at me. They called that we're gonna call HUD. We're gonna tell HUD that you're taking our cookout and barbecue money and I'm like, call HUD. Tell them not to send your money to me anymore, to send it directly to you. And so it gets frustrating because it's a lot of education that you have to do, and you have to kind of like calm down not to get incredibly upset because this person's not even thinking about like you're trying to do something for their kid in their kid's name. And the fact that they don't have access to it, because I did this before, the version 1.0, and the parents had access to these accounts because they were the custodial of the account. And, Tuesday, they needed money. Wednesday, they needed and it was always an emergency. And the money that we built up for the kids was gone. And so a better mousetrap is this account, we're the trustee. And at 18, it transfers directly to the kid and the parents can't take the money out. And now I'm saying you have to invest too. So if you're going to be eligible for the extra money, you've got to be able to give your kid $15 a month. So that's it.
There you go. Very unique and very real response to that. Ben, I mean, we give people free Wi-Fi. But are you doing a project, Ben? Right? I mean, no, I think, and Charles really touched on the part. I always like to say it's not just about the bricks and the sticks, and it's bridging the technological divide. We now have on our new projects, we do free telemedicine, right? So we're doing this, which I'm really excited about. We're doing a senior building with childcare in the first floor because of the mix between the generations, right? So it's not just about the living, it's about our seniors sort of having new leases on life because they're spending time with young children and these children benefiting from older folks. But I guess the takeaway is we all sort of need to, and it's back to my big thing about colleges and just minting better people. I think we all owe it to ourselves, even if you're not in the affordable space, you're never getting it. But to counter some of those stereotypes and support, don't be a NIMBY, right? Like support the initiatives that will allow us to build more affordable housing because studies only shown it just makes communities that much better, right? I mean,
one of our partners or my co-founding partner is almost 80, and he always laughs. He goes, it's finally the old white guys are dying off and they're not on boards of supervisors anymore. I mean, one only has to look at the Prince William board. It wasn't too long ago, it was all white guys all left to go support Trump. And now it's all primarily young black women lead. And not surprisingly, guess what? Huge push to affordable housing. And so we're starting to see the politicians and, making an important point, because it really is. And it's not just housing, right? I mean, it really is about our economy and our communities. And so we all have a vested interest in having people have good places to live and get the services and all that stuff. And so I how many people would love it for everybody in this room to get into affordable housing, but if you just don't be anti-affordable housing, right? At least show up at your board of supervisor meetings and speak in support of don't be, that we've all been in front of boards where you get a lot of those folks saying, we don't want those people here. And those people could be black, they could be Spanish, they could be poor. It's across, but the socioeconomic. But yeah, I guess that would be my big takeaway is just be a proponent. Go out there and because it's a battle. I mean, it's a battle doing this stuff, just because sometimes I joked about the gray hair, but sometimes you wonder, is like, it's a deck stacked against us. Like, we're trying to do good things, right? And you feel like it shouldn't be this hard, right? I mean, it should not, right? And so we need all the support we can get, whether you're literally fighting alongside us or, yelling from the stands, but we definitely need folks supporting this.
That's a call to action to you, everybody in the audience, everybody on Zoom directly. We had a question in the audience.
I have a trio background, civil engineering and telecommunication, and I'm also a real estate appraiser. And so some of the things you mentioned, it made me think of when I was a civil engineer for DC government, and I used to design asphalt, concrete, and things. And you mentioned about the affordable units that don't produce equity or profit. They have no profit. And it just hit my head like, if this was some soil and I was trying to design a particular mix, what do I normally do in this case? Because it's contaminated. I can't use it for the government project. And so what I typically do is I go in my office and I redesign a new mix for another type of project that I can use that soil on, so that the contractor is not losing money. And another thing I wanted to think of, have you ever thought of the sandwich technique, which is for every project you have that doesn't have the ability to produce profit, create one beside it, or call it a surrogate that can support, and it can lean on it. It can use some of that equitable interest or profit to support the child in need, surrogate, and eventually, the market will change, things will change, and eventually it will support itself. I'm a big fan of reallocating property that is on condemnation lists. I can tell you now the reason it's there is because it's not producing tax revenue. So if you can create a project that can produce tax revenue without tearing things down, and destroying it all the way, at least keep the foundation. This is from my appraisal hat. If you keep the original foundation, you can grandfather into many of the building codes that you could not tap into if you went with new construction. And we tend to call those inlays. I love mixed-use properties because it does allow you to produce income, and you're not relying solely on the tenant or resident to support the financial profit of the building. So that was just some of the things that crossed my mind. I think sometimes we get into the construction side of things or the development side of things, and we don't look at a maternal side of a thing. And if I was a mother and this was a child, and this child was smarter than the other child, we would get that child to help out with the homework. So let's do a building the same way. Let that building support another building. And as developers, I think a lot of times you can get into communities if you offer or if we create legislation that forces a profit, like these people who build all the high-end buildings and don't reinvest into the community. If we make a clause where they must build or put money into a trust fund that supports affordable housing, we have to stop letting people come in and just erect buildings, and then they're only doing it for investment purposes because then they don't rent it to anyone. I find that to be a real big problem. And it's funny, I also work on oil projects, and I remember um, you mentioned something about the teachers. Once they reach that what is it, that timeline, they're like, oh, okay, I want to sell my house because now I don't have to, I guess, pay the grant back. And many moons ago, I mentioned to my daughter, and she says it's called a community trust. I had no idea what it was called, but I thought it was a great idea. And I got it from oil companies. They sell perpetual subsurface rights. And it's interesting. You could sell your house, and if the guy sold the subsurface right, you don't get any of that check. He keeps collecting that check. And I thought that was really interesting. I was like, so why can't we do affordable housing like that? Find out why these people are so quick to leave these properties and do a survey, because my concept is, why is a community trust just limited to a particular affordable group? Why don't we have moderate community trust where when their incomes elevate, they have the ability to say, hey, you have equitable interest in your home, and you got this through a program where we're sharing the interest. You can graduate to another equitable interest program, into another one, into another one, and keep the equity rolling. So that was just some suggestions from sitting over here.
I appreciate that. Thank you. And very thought provoking. So thank you for your contribution there. I think we're coming up on time. So I'd love to get to all the questions. We do have other panels though. So please come out to the next panel. I do want to give the floor to Charles and Myron, or to Myron. So the floor is yours, brother. Whatever you want to talk about, plug AYA, anything.
I mean, I wish I had something as exciting as everything you guys are talking about, because that's amazing. I mean, look, I'm just helping affordable developers solve the capital stack. That's where it
Just.
yeah. So, whether it's gap financing, whether it's senior financing, whether it's the full thing, I mean, that's the challenge. So that's what we're doing. So to developers who have that issue or concern, I'd love to talk to you and see if we can work together.
How can folks get in contact with everyone here? Can they get in contact with you, first of all? Because I got in contact with Ernst after texting him 18 times, but I did get it. How can folks get in contact with you?
I mean, Myron Adote on my LinkedIn, or my email, Myron at aya-enterprises.com, are the easiest ways to reach me. And look forward to working with you.
For folks that are hiring as well, is anyone hiring? There you go. So Scott mentioned DCHFA, and Ernst mentioned not only the fund, but also that they are looking for qualified and talented individuals. So how can folks reach out to you, Ernst?
LinkedIn is probably the best way. Ernst Valerie, ERNST, VALERY. Our fund website is actually down because of a tragic accident, or not murder, that happened in Baltimore. So LinkedIn, and then I will get back to you.
Ben?
Yeah, LinkedIn. I'm gonna have some cards here if anybody in the audience, and then B. Miller at wellington-development.com. So happy to chat with anybody.
And then Charles, and then Scott.
Sure. So you can reach me on LinkedIn, Charles Sims. I don't know exactly what the number is behind it, but it's there. And then you can by email also. So that's just C Sims. It's SIMS at APAH.org. So feel free to reach out to me. And for folks here in the audience, I've got a bunch of cards. I don't remember how many, but for most folks.
Yep. And you can contact me on LinkedIn. My email is shutter, HUTTER @dchfa.org. Got plenty of business cards. Happy to talk to folks if they come down.
Wonderful. So I want to quickly plug this panel series that we're doing in coordination with Georgetown University, where you get to vote on what type of panel that you want to see next. So here's a list of options. I want you to head over to my LinkedIn where you can vote. And then we'll do these as frequently as you can, as many times as we can get an impactful crowd based on these topics. So you're in control of what comes next. I want to say thank you to the audience, and I want to everyone join me in saying thank you to our esteemed panelists.